Hello everyone, this is just a quick catch-up video on the Mapletree REITs, right, which I think are quite near their 5-year lows in terms of valuations, right, due to primarily the tariff war fears, right. So we'll look at the industrial logistics and Pan Asia commercial trust. Again, all these things, this data is from Retirement's blog, which I have done a video on how to go about getting them. Right, obviously they're in different sectors, right, of which I think Mapletree Logistics Trust stands to get affected the most from Trump's tariffs, right. But in terms of price, right, they have been quite suppressed recently, so I want to see whether there's some kind of buying opportunity, right. In terms of dividend yields, I think it's quite rare to see the Mapletrees get 7%, right. So all of them are actually relatively attractive in terms of dividends you can get at the current price, right, of which Mapletree Logistics Trust has the highest dividend here at 7.7%, right. But I will tell you why I don't like to take this number and why I'm not a fan of Mapletree Logistics Trust in this video, right. In terms of NAV and dividend yield, Mapletree Industrial Trust looks the most expensive, right, because price to NAV is still above NAV, right. So Mapletree Logistics Trust is still trading above NAV, and I think there's some good reasons for it, right. Whereas Logistics Trust is already 20% off NAV, and Pan Asia is even more below NAV, which is 34% below NAV, right. Market cap wise, they're all the same, roughly the same, not all the same. Right, occupancy wise, you can see Mapletree Logistics Trust has been not very good, right, 92.1%. There's US occupancy concerns, right. Mapletree Pan, on the other hand, has been underperforming in terms of almost everywhere, right. But the serious occupancy issues actually are occurring in China and Japan, right. Korea as well, but Korea is a smaller part of the pie, so I'm not so worried about Korea, right. But China and Japan are big issues for Mapletree Pan, right. The rest I won't talk about too much, I think. Yeah, so this is Mapletree Pan's poor results. You can see that even MBC is not doing well, right. 92.5% is not a good occupancy in my opinion, especially for Singapore, right. Retention rate, I guess 75% is not too bad, but rental reversion is only 2%, right. So this is quite bad. I think Singapore also does have some kind of excess office supply somehow, alright. The other properties are doing well though, alright. So I cannot say that it's totally bad, but occupancy is decent, right. Retention rate is good, right, and rental reversion is 8.3%, right. We look at China, Japan and South Korea, they're all doing badly, right. Occupancy is all below 90%, rental reversions are all negative and some quite badly so, right. You see Japan is -9%, right. This was the shocker in the last I think 2 quarters ago, right. Japan doing badly, alright. And South Korea, while it looks very bad here, it's not a very big part of portfolio, so I'm not super worried about South Korea, right. In terms of retail assets, right, so in front is office assets, right. This one's all office assets, right. Retail assets, they only got 2 main ones, VivoCity and Festival Walk, right. You can see VivoCity is still their flagship, right, doing very, very well, right. Festival Walk, on the other hand, the rental region is quite awful, right. So I think they're suppressing the rental so that they can get occupancy, but I'm not sure how sustainable this is in the long run. Okay, so we'll look at the balance sheet, right. So this is the balance sheet. Interest coverage ratio wise, you can see why I like MIT, right. 4.3 times interest coverage ratio over the other two, which is below 3, right. Below 3 is already considered not very good, right. So balance sheet is a bit stretched both for logistics and Mapletree Pan Asia Commercial Trust, right. Cost of debt, you can see relatively there for most part. Logistics seems to have access to cheap debt, right. But even so, I'm not very happy with their performance, right. Pan Asia, on the other hand, looks a bit expensive. Hopefully this number can go down, right. You can see red color all here is Mapletree Logistics, right. But I'm not so worried about this line I'm more worried about the last one, right. Gearing ratio including hybrids, 44.5%. This is pretty high, right. So in terms of debt or gearing ratio, right, actually Logistics Trust has the highest gearing ratio, which is a bit scary in my opinion. Mapletree Pan Asia recently divested a Singapore property which brought their gearing down to below 4%, right. So it's a conservative move. I think in general in this current environment they were lucky to do so, right. Mapletree Industrial Trust, not super worried even though this is a bit high, on the high side as well, because the interest coverage ratio is strong, right. It means they should have the cash flow to cover the interest costs, right. This one is about diversification, right, where whether or not they have very concentration risk rather, right? So Mapletree Pan Asia, you can see, has more concentration risk, but I think this 60.7% is Singapore, so I actually view it as a pretty good thing. Okay, yeah, so nothing much here to talk about. I don't think I'll talk about this, right? Yeah, this I'll talk about. This is the main reason why I don't really like Mapletree Logistics Trust. You can see the dividends that they pay out to unit holders, right? Only 79.1% comes from actual operations. That means to say, operations means that they rent out the property, they collect the rent, they minus off the cost, then the leftover they give out as distribution, right? Only 79% come from that, which means that every dollar they pay you, right, only 80% comes from this operational money, right? Then where does the rest come from? 13.4% actually come from management fee paid in it. That means to say, instead of paying the management fee in cash, right, they create more units of Mapletree Logistics to pay them, which means that shareholders get diluted in the long run, right? Some more, another 7.5% here, right, it actually comes from they sell properties, make a profit, then give the profit to unit holders, which I think is not sustainable. Even though they have been doing a very good job overall at this, over a decently long period of time, right, I'm still concerned. Alright, so this is why I don't like Mapletree Logistics Trust so much, as opposed to the other two. I have a slight preference for Industrial and Pan Asia. I'm not saying that they don't come with their issues, but you can see that their operating distribution proportion is very high, 95%, right? Sorry, 96.2% and 95.9%. So this is very high. That means to say there's very little, I would say, financial movement, financial. I don't want to say manipulation. I don't think it's manipulation, but yeah, something to do with that. That the distributions are not artificially propped up. Okay, I'll put it that way, right? So yeah, so if we look at the MIT, we'll see that over the years, right, actually last time 92.5% came from operations, right? Now it's 95%, right? The trend is going up, so I like this MIT, right? So for this is MLT, which is not good. Last time it's 85.5%, now it's dropping to 79.1%. And you can see the red color part, management fees paid unit, is getting thicker and thicker, the red color one. Right, so these are things that are not very good. I'm not very happy with MLT because of this. Right, in terms of Mapletree Pan, which is this one, right, generally the trend is good as well. DPU from operations is going up to 95.5% from 86.4% in the past. Right, so yeah, I think that's a good thing. In terms of unit price, you can see they're quite near the lows. Right, now it's 1.92. Is near 1.83. This is MIT. MLT is 1.08, which is near 1.03, and Mapletree Pan is 1.14, which is near 1.09. Right. So MLT and MPAC looks cheaper, right, than I guess MIT, right? But I think there are good reasons for it. MLT is macro reasons because of Trump tariffs. MIT is their properties have been performing poorly, except for VivoCity. Alright, so they are cheap, but for different reasons actually. Yeah, I should have written here for different reasons. Right, this is MLT's latest result, which I thought was not too bad, right? Given that you see rental revision is actually generally positive. This MLT, alright, but macro is not helping for them. Right, so in terms of dividend yield, as I said before, I wouldn't take 7.7% for MLT, right? In fact, I'll take 80% of this, which means that I'll think that MLT's current dividend is around 6.16%. Right, that's how I will calculate because I'll look at operational dividends only. Right, for that same, if I want to do that, then the same approach has to apply for MIT and MPAC. So MPAC, if I take 95%, is around 6.7%. Right, for MLT, sorry, not MPAC, sorry, this MIT, 7.7% dividend, right? 7.07% dividend multiplied by 95%, I get 6.7% dividend, right? And MPAC will be 7.33 also times 95%, roughly. So this one is 6.96% dividend, right? So I think in terms of attractiveness, probably MPAC, right? You can hope that there's a turnaround in their shopping centers, right? So that's how I look at it. All right, anyway, price to NAV also very close to the all-time lows, right? The current is 1.1 for MIT, low is 1.06, right? MLT 0.78 is the low, currently is around 0.8, right? And MPAC 0.66, the low is 0.65, right? So all of them are very near their all-time lows lah. Sorry, right? So okay, finally I'll just read this, which I thought was quite interesting thing on the Trump tariff war. This is macro lah, so if you're not interested you can turn off, right? So this actually from Twitter or X, right? So this Peter Duan was I think trying to summarize a conversation with Lynn Eldon. I think she's some macroeconomist which is quite well respected. I also think she's quite good, right? So they were discussing some things about the tariff wars and how it's likely to turn out, right? So for US being the world's reserve currency is a double-edged sword. On positive side, it creates global demand for the dollar because they need to use it in trade, global contracts and central bank reserves. However, the same demand, right, makes domestic manufacturing less competitive because when your dollar is strong, right, it's very hard to buy things from US, right? Because I need to buy USD, but buy USD is expensive, right? So this causes exports to get hollowed out, right? So that means manufacturing starts to move elsewhere, right? So even with the political will to reshore, that means to bring the manufacturing back, do the US have human capital and supply chain to scale quickly, right? That's a big question mark, right? It could take 5 to 10 years to rebuild the expertise and be globally competitive. And I'm also questioning whether or not this will actually create jobs, because nowadays manufacturing is very automated. There are very few manpower required to actually do the manufacturing work. It's mostly machines and some technicians overseeing the machines, right? So other than that, they talk about US and China fighting in the trade war. There are two main protagonists, right? So who's going to win, right? Of course, you can say that US has the economic advantage because they are the buyers, right? If the buyers don't buy, then the country that is selling, right, importing country, I think, yeah, what I'm trying to say here is that I think China will suffer because they're trying to sell and no one is going to buy, or they're going to buy less, right? So yeah, so that's why China will suffer and more than US lah. Although US will also suffer lah, I believe both will suffer, right? So anyway, but this is China's weapon, right? Trump wants to bring down the 10-year treasury interest rates so that they can refinance debt, right? But China owns a lot of these treasuries, which means that they can cause the debt interest rate to spike by selling them, right? So I believe that this is what was done recently, and maybe that's what caused Trump to actually flip-flop on the tariffs, right? So he said something to the degree that there was a hold off for 90 days, and I think something like they will bring down the tariffs for everyone except China because everyone else came to the negotiating table. And one of the reasons why people speculated Trump did this was because of the spike in the 10-year treasury bill interest rate, right? So he was quite worried about that. That could signify that the US dollar is actually crumbling, right? But I think they suspect it's because China is dumping the treasuries, right? So China does have their own weapons as well lah, basically, right? So anyway, this one, the last one is just talking about the fact that generally when you take on debt, the government has only 3 choices to get rid of it, but they always try to inflate through printing money because it's the easiest way, right? You don't want to be unpopular by trying to tax people or default. You can't default lah. Default is the worst thing, but taxing people is unpopular, so you try to inflate it away, right? So in the end of the day, generally it's very hard to reduce the government deficit in the US because of the fact that most of them are kind of stuck in military spending and entitlements, right? So I think what this is trying to say is that she believes in some other form of some other form of store of money, which I think this person, right, Lynn Eldon, is actually a fan of Bitcoin, right, as well as I think the author of this thread, right? So again, no financial advice given. I'm just sharing something because I thought it was interesting, right? Thank you for listening.